Let's move on to the convertible debentures. So once again, we need the cost and we also need the market value. Now guys, if you refer back to your lecture notes, I told you to perform this calculation in 2 steps. In step 1, we are going to calculate the future value of each alternative. If you go back to the information provided in the question, we are told that the debenture holders have the option of converting the debentures at the end of 3 years into 60,000 ordinary shares, or they can continue with the existing debentures. So if we are calculating the future value of each alternative, we have to calculate the future value of the 60,000 ordinary shares in 3 years' time, and the future value of the existing debentures also in 3 years' time. Okay, so first, let's calculate the value of the 60,000 ordinary shares in 3 years' time. Then we'll calculate the value of the existing debentures in 3 years' time. So we calculate the future value of each alternative. So how are we going to calculate the value of the ordinary shares in 3 years' time? You can perform this calculation in either one of 2 ways. First, guys, please note, we have already calculated the value of the ordinary shares today. Each share is worth 111 Rand and 18 cents today. I have also been told that dividends are expected to grow by 5% per annum. So the value of one ordinary share today is 111 Rand and 18 cents. That is my present value. I am trying to calculate the value in 3 years' time, so N is going to be 3. We know that dividends are going to grow by 5% per annum, so I is 5%, and you can then calculate your future value. So that is going to give me 128.7 per share. That is my value per share. So I need to multiply that by 60,000 shares to get the future value of this alternative. If you don't like that calculation, you could have also performed the calculation using Gordon's dividend growth model. Using Gordon's dividend growth model, we take the future expected dividend and we divide by the cost of equity less growth to get our present value. Now, if you go back to where we originally performed this calculation, if I wanted the value of the shares today, so this gave me the present value of my share today, I needed to include the future expected dividend in my calculation. So in other words, I put next year's dividend in the calculation, and that then gives me a value today. So it jumps back 1 year. So if I now want to calculate the value in 3 years' time, so I want the present value in 3 years' time, that means I need to put D4 into my calculation. If I put the dividend for year 4 into my calculation, that jumps back 1 year and it gives me the value 3 years from now. So please note, you can see I'm applying exactly the same logic. If I want the value of the shares today, I use D1 in my calculation. If I want the value of the shares in 3 years' time, I use D4 in my calculation. you always use the next expected dividend. So if the current dividend is 18 Rand per share, you need to increase that by 5% for each of the 4 years. So that gives me D4, or the dividend that's expected in year 4. We then divide by our cost of equity, which is 22%, and subtract growth of 5%. And you'll see this is going to give you exactly the same answer. All right, so it's up to you. Obviously, you don't have to perform both calculations. You can do whichever calculation makes more sense to you, but you do need to calculate the future value of the 60,000 ordinary shares in 3 years' time. So that was the one alternative. Either the debentures will convert into ordinary shares or they will remain debentures. So we now need to calculate the future value of the other alternative if they remain debentures. Now guys, if they are going to continue as debentures, are we dealing with a non-redeemable debenture, a redeemable debenture, or a convertible debenture? If this option is exercised, because remember, go back to the question, the holders are going to have the option, either they're going to convert into ordinary shares or they are going to continue with the existing debentures. Now, if they continue with these existing debentures, it means they won't convert and they won't be redeemed. So we are dealing with a non-redeemable debenture or a debenture in perpetuity. So if I want to calculate the value and I'm dealing with a debenture in perpetuity, my present value is equal to the interest cash flow divided by the cost of debt. So how do I calculate the interest cash flow on these debentures? Remember, we use the coupon rate to calculate the interest cash flow. So I'm going to use this 15%. And the debentures have a par value of 10 million Rand. So that's made up of 100,000 debentures at a par value of 100 Rand each. So if I want to calculate the interest, it's going to be 10,000 Rand multiplied by 15%. Then because this is a debenture and we pay interest on debentures, you need to consider the tax consequences. Remember, interest is deductible for tax purposes. So if you go back to the information provided in the question, we were told that the tax rate was 28%. So if the company is going to get a tax deduction for the interest that they pay on the debentures, we need to calculate what this interest cash flow is after tax, meaning I need to multiply that by 72%. We then need to divide by the cost of debt. Again, go back to the information provided in the question. We were told that similar debentures are currently trading at a 20% yield to maturity. So that is my cost of debt. And that is what I use as the discount rate to calculate my market value. And that's what we're currently doing. We are currently calculating the present value. Remember, this is your market value. So what do you use as the discount rate when calculating your market value? You use the cost of debt. When calculating your interest cash flow, you use the coupon rate. And then please note once again, both your interest cash flow and the cost of debt must be after tax. So we need to multiply this by 72% so that we get the cost of debt after tax. This is then going to give me an answer of 7.5 million rand. Now please note, I said to you we are trying to calculate the future value of each alternative, so the value in 3 years' time. We calculated the value of the 60,000 ordinary shares in 3 years' time, and we have now also calculated the value of the debentures in 3 years' time. So this requires a little more explanation. Let's look at it on a timeline. If you go back to the question, the debenture holders have the option of converting the debentures at the end of 3 years, either into ordinary shares or they will continue with the existing debentures. So they only have this option at the end of 3 years. So for the next 3 years, these debentures will continue as is. So for the next 3 years, they'll continue paying interest on these debentures. This option only becomes available 3 years from now. So we've got 3 years, and then this option becomes available. So I want you to assume that we are sitting at this point in time. We are sitting 3 years from now. 3 years from now, they can either convert into 60,000 ordinary shares, or they can continue as debentures. If they continue as debentures, into perpetuity, the company will continue paying interest at a rate of 15%. So the interest has been correctly calculated. And the cost of debt into perpetuity, based on current information that we have available, is 20%. So the value of these debentures in 3 years' time, at this point in time, is 7.5 million rand. Now please note, and this is where students get confused, this is the same as the value today. And the reason why the value today, so at this point in time, and the value 3 years from now is exactly the same, is because we don't have any growth in these debentures. Let me take you back so that this makes sense. If we go back to the ordinary shares, the reason why the ordinary shares have a different value today as opposed to the value 3 years from now is because the dividends are expected to grow by 5% per annum. So the reason for the difference in the value of the shares today and the value of the shares 3 years from now is because of this growth rate of 5%. However, when we look at the debentures, the growth rate is 0. There is no change in the interest payment. The interest payment for the next 3 years is going to be at 15%. And also the interest payment after that period is going to be at 15%. There is no growth. The interest every year is exactly the same. So whether I perform the calculation today or if I perform the calculation in 3 years' time, I'm going to get exactly the same answer. So please note, for the debentures, the value today is 7.5 million and the value in 3 years' time is also 7.5 million because there is no growth in that interest payment. If we didn't have any growth in our dividends for the ordinary shares, then the value in 3 years' time would also be the same as the value today. The only reason for the difference is because of the growth of 5%. All right, so please understand that. The value that we have calculated above is the future value in 3 years' time, and it happens to be the same as the value today. So we have now calculated the future value of each alternative. We know what the value will be if they convert into ordinary shares. It's a value of 7.722 million. We also know that if they continue as debentures, the value 3 years from now is 7.5 million. Now, what was the purpose of performing these two calculations? Why did we calculate the future value of each alternative? Because we need to determine which option the holder is going to select. If you go back to the information provided in the question, the debenture holder has the option. So they are obviously going to select the option that gives them the highest value. So will they convert into ordinary shares or will they continue as debentures? It has a higher value if they convert into ordinary shares, and therefore the debenture holder will decide to rather convert into ordinary shares. Please remember, guys, if this is at the option of the company is going to select the cheapest option. So they would then rather have them continue as debentures. So you need to check in the question, is it at the option of the company or the option of the debenture holder? In this case, it's the debenture holder, so they will select the alternative that is most favorable to them. In other words, they will opt for conversion. So that is the whole point of performing the calculation in step 1. We are trying to determine what the debenture holders will do. Now that we know what the debenture holders will do, we can calculate the market value of the debentures in step 2. So we start with our future value. And the future value is the value in 3 years' time that we calculated in step 1 above. We know that the holders are going to select conversion into ordinary shares, meaning our future value is going to be 7,722,000 Rand. That is our future value in 3 years' time, and we said the holders would select conversion as that has a higher value. So that is my future value. N is obviously going to be 3 because that is the value in 3 years' time, and we are trying to calculate the market value, which is the present value today. So N is 3. Then for the next 3 years, the company is still going to have to pay interest on these debentures. So we have debentures with a par value of 10 million Rand, and the company pays interest on these debentures at a rate of 15%. And remember, that must just be after tax. So that's exactly the same as the interest calculation that we performed above, because we use the coupon rate to calculate our interest cash flow. All right, so the company pays interest at a rate of 15%. That is always based on the par value of the debentures, and we need the after-tax cash flow. Then I is going to be the cost of debt. Once again, we do already have this information. What is the cost of debt for the debentures? It's 20% before tax. So we just need to multiply that by 72% to get the after-tax cost of debt. So the cost of debt, or the rate on similar debentures, so that's going to give me 14.4%. And I'm then going to compute my present value, which will give me the market value of these debentures today. So please note, just as a recap, and I'm going to say this so many times so that you never forget, because it's a common mistake that's made. You use the coupon rate of 15% to calculate your interest cash flow, and you use the cost of debt, or the rate on similar debentures as your discount rate when you are calculating your market value. So we can then solve for the present value. All right, so to wrap this up, remember we need the cost and we need the market value. We've calculated the market value of the convertible debentures, and we also need the cost. Now please note, when we perform the WACC calculation, that is a long-term calculation. So you can't include the cost of debentures or 14.4% as your cost for the debentures, because they will only be debentures for the next 3 years. So this cost is only applicable for the next 3 years. You must use it when calculating your present value, because over here we are only looking at the next 3 years. So for the next 3 years, we use the cost of the debentures. However, when we calculate our WACC, that is a long-term calculation, and we said in the long term, these debentures are going to convert into ordinary shares. So in my WACC calculation, I am not going to use 14.4% as the cost of the debentures. Instead, because the debentures are going to convert into ordinary shares, I'm going to use the cost of equity of 22%. Once again, guys, I did cover this in detail in our lecture, so if there's anything you're unsure of, please, you must go back to the lecture.